This week sees the latest Jackson Hole Symposium kicking off in Wyoming. And of course, when we cast our minds back, we have seen big volatility around this event in the past. So it leaves traders wondering whether this will be similar or whether this is going to be a bit of a nothing burger, as has been speculated by many. So let's look into the event, see who's going to be speaking, and also gauge exactly what we could see in terms of market volatility from this Jackson Hole Symposium. So it's worthwhile noting that we don't always see major volatility at the Jackson Hole Symposium. Sometimes we do. You can see back in 2022, we saw Jerome Powell warning of potential pain coming their way as they tried to fight inflation. Other times it's just average price action that we see on any other week or month. And now what's notable here is that we just see these odd occasions, and really it's just a case of knowing whether it lines up with the potential major shift or major announcement from the central bank. Now, the main event for this week will be Friday's appearance from Jerome Powell. And arguably, you could say we're not going to see huge volatility because of the fact that he's not going to be in the job very long. So let's just try and think of the kind of outcomes that we could see that could cause volatility. On the dovish side of things, could he allude to the potential for a 50 basis point cut? It seems unlikely. We've just seen strong PPI data coming out of the US. So inflation concerns still do remain. Of course, the flip side of it is that we've seen poor jobs data from the US. So there is the justification for a looser monetary policy stance from that side of things. But you have to understand that markets are now pricing in pretty much a rate cut at every meeting from here until the end of the year. So even that would probably stand up as a decent amount of easing from a relatively cautious Fed chair that is aware that we could still see a significant resurgence in terms of price pressures. So on the flip side, we could see him ruling out a 50 basis point cut. And I've seen some people saying that this could be the thing that causes markets to roll over. But bear in mind, at the moment, markets aren't pricing pretty much any degree of 50 basis point cut being priced into the market. So I don't necessarily think that that's going to be a huge concern. Instead, potentially moves around. Maybe we don't see the 25 basis point cut in September. That's unlikely. Or maybe we don't see one at each meeting. Maybe he's taking a more cautious approach and like that could cause volatility. So you have to try and understand the different areas where we could potentially see it. Now, we've seen in the past significant volatility off the back of different announcements, as you can see here, in terms of appearances from Fed chairs followed up by the ECB governors. Now, this time around, I haven't seen confirmation that we're going to see Christine Lagarde speaking at the event. The likes of Andrew Bailey at the Bank of England and Macklem at the Bank of Canada appear to be confirmed. And so we still have potential volatility for, say, the Canadian dollar or the British pound and the likes of the US dollar, of course, US equities and the like with the Powell appearance. But those two for Macklem and for Bailey, those are on Saturday. So, of course, markets are closed. You'd be looking at the potential for markets to open again on Monday for any reaction to those comments. Therefore, Friday's event really does provide the main ticket for people to be looking for volatility within market hours. Now, we can see here that you do often see significant swings in terms of the bonds market, and that's the kind of thing that we could see once again, because of course we're sort of torn between a number of different factors at the moment. You've got concerns around the sustainability of the US debt. You've got the fact that interest rates are relatively elevated and trying to price in the possibility of a more dovish swing from the Federal Reserve. You've got the fact that the US is potentially going to be taking in a significant amount of tariff revenues, and that could ease some of the concerns around the debt. But also those tariff deals coming into play means that the sort of concerns around the breakdown of US exceptionalism feels like it's overblown, and we're seeing that ease off and yields are coming down as a result. So a number of different factors coming into play at the moment when it comes to the bond market. But it's notable that we have seen significant swings around it. And where the bond market goes, so we see the FX markets go as well. So keep an eye out for relative moves for the US bonds. In particular, you can see here the 2-year, as you can see here, more recently, the one that's been providing significant volatility. Bear in mind the 2 years more related to where monetary policy is over the near term. And so it stands to reason that that's the one that's going to be moving, because we see expectations for, say, the Federal Reserve shift as a result of the commentary that comes out in the Jackson Hole Symposium. So do we see the major swing in the bond market? That could provide the basis for significant dollar devaluation if we see a particularly dovish stance coming out from the Fed chair. Now, this is the expectation at the moment for the Federal Reserve, and we can see that the base case scenario now is 2 rate cuts. That has been a significant shift, and that comes in no small part due to Thursday's PPI number, which came in very hot at 0.9 for the month. And so we're seeing a pullback from those expectations that we see 3 rate cuts over the remainder of this year. So Powell's appearance essentially provides the basis for either a continuation of that swing away from rate cuts or a move back in that direction. If we see pricing of additional rate cuts, it points towards further dollar weakness. If we see a move where we pull back and further hesitancy from the Fed chair, then that could start to strengthen the US dollar as a result. Bearing in mind on a equity front, you can see the S&P 500 by and large doesn't have a great time during September, relatively average during August. So we're coming into a period where markets generally struggle a little bit. Now, if we're looking at the possibility of a dovish stance from the Federal Reserve, then you're looking at markets possibly sort of picking up, thinking that this is good news. We're going to see a more accommodative approach from the Federal Reserve, and that should lift equities in particular on the front end, where we see those big tech names. They do very well where we see a more dovish stance from the Federal Reserve coming into play. If we see that hawkish stance, maybe we see things rolling over a little bit as a result. Now, in terms of gold, I'm just wrapping all of these up and then we'll look at the chart. So gold is another topic that's going to be particularly important, because we have, of course, more recently seen huge gold purchases from central banks over recent years. That is a shift away from US treasuries as that sort of treasury asset, that holding that these central banks typically have. It used to always just be a case of head towards those US treasuries. That's not necessarily constantly the case. Now we're seeing a move into the US into gold in a pretty big manner. So what will be the outlook going forward in terms of the purchases of different assets? What will be the outlook in terms of monetary policy? If we see a more dovish outlook, that generally is good news for gold. You know, that means that we have the prospect of volatility in that precious metal as a result. Let's look at the dollar index first and foremost and see how things are shaping up for the greenback. So here is the chart for the US dollar index. And what we can see here is, let me just, oh, there we go. What we can see here is that essentially, there we go. We've seen this significant deterioration since Trump came into power. More recently, sort of consolidating a little bit and moving into a phase where we're sort of losing a little bit of that downward traction. In part, that comes because of the fact that we're actually seeing a raft of trade deals, or we have seen a raft of trade deals coming into the fore. And as such, you're not necessarily as fearful around the breakdown in relations and the move away from US assets as a result. So in terms of the shorter time frames, we can see, let's just grab this and look at the daily. You can see here that we've been in this downward trajectory and then now seeing this sort of almost ABC style retracement of that wider move. So from a bearish perspective, we can say, well, we've come into this deep fibs retracement zone between 61.8 and 76.4 and pull back. From the bullish perspective, you can see, well, we've dropped from that latest push higher, but now we're sort of gradually moving lower. So we're losing a bit of that traction. In terms of that latest retracement, we've come towards that 76.4 fib, now starting to gain a little bit of ground from there. Let's just get rid of that 61.8. So like I said, if we're seeing Powell coming in with notably hawkish tones, that could start to see things pick up, and this forms a base as we move into the next leg higher for the US dollar. If we see him coming out with a really dovish comment, which I don't necessarily think as being likely, that could provide the basis for further downside, but crucially, a breakthrough 96.63 would be required to point towards this phase being over and that the bears are back in charge for the US dollar index. In terms of the S&P 500, let's just jump onto that so we can see very clearly the trend is lovely and remains very bullish. And we can see here that more recently we've posted that new record high. We're seeing a little bit of downside at the moment. If we see Powell coming out with a very cautious tone, yes, we could possibly come into this deep zone, your 6,300 kind of area. But 62.11 is the key level. We just keep adjusting those swing lows and expecting further upside to come. So short term, if we see any downside, I'll be surprised to see it actually break the 62.11. If that happens, that's where the wider bearish phase comes into play. Until then, short-term downside looks exactly that. It looks like a potential opportunity for the bulls to buy the dip once again. And then let's look at gold prices. We can see that gold has been consolidating a bit of late, notably as we see a potential deal coming in the offing between Russia and Ukraine. We're seeing the geopolitical fears easing a little bit, so that takes a little bit of the shine off this precious metal. We're also, of course, pushing back a little bit against the idea that we're going to see 3 rate cuts from the Federal Reserve. That, again, sees things sort of taking the heat off once again. So from a wider perspective, we can see that this is trading largely between this sort of zone here, right? So we can see that we're trading between the sort of 32.50, 34.35. And at the moment, we're in the middle of that. We're moving towards the downside. So further downside does look likely over the near term. If we see Powell coming out with a really dovish statement, yeah, that could lift things over the short term. But I personally think that we're probably going to be seeing a little bit more of the same for the time being. Further downside, but ultimately it's just a case of remaining within this range and continuing as we go on, and things potentially ramping up later on in the year. Like I said, if we're looking out for the events, the Powell one is the big one because it's happening on Friday. We've also got appearances from the likes of Bailey and Macklin from the Bank of England and the Bank of Canada, respectively. Bank of Canada's just come out with the latest inflation data, or Canada, I should say, not the bank. That was 1.7, so it's coming weak. We're seeing a weaker Canadian dollar as a result. So keep a close eye out on potential US dollar. Let's just see dollar CAD volatility. So we can see here that the US dollar is starting to potentially base out here when it comes to dollar CAD. Here we go. So long term, the trend is very bullish. We can see here we have not broken the swing low and now potentially basing out. You could say that this is a retracement of that sell-off. Let's just get the 76.4 in. There we go. So are we just retracing this before we see the sell-off coming into play? Not sure, but I would say probably just follow this over the short term. You can see this looks like a sort of retracement phase here. Lower highs, lower lows, reverse into higher highs, higher lows. If we break down through your support level of 1378, then you can negate this near-term bullish setup. But at the moment, things are looking quite positive here for the US dollar against the Canadian dollar. And then, of course, we've got that appearance from the Bank of England's Andrew Bailey, and the outlook for the UK is a bit muddled at the moment. We've got question marks about growth now because we actually saw better than expected GDP figure coming off the back of 2 negative monthly prints. That's made up for it in part. So the economy not necessarily looking as bad as had seemed previously. From an inflation perspective, though, it's still very troublesome. This week we do have UK CPI, so I'm not necessarily going to say exactly what the outlook is for that because we don't necessarily know how that's going to come in. But by and large, the UK inflation data looks to continue to be a problem. I've already provided a video, so check out our site for that. But essentially, it shows you that inflation is here to stay for the UK. By and large, probably going to stay within the mid-3s for the remainder of this year. And therefore, it's unlikely we're really going to be able to see too much from the Bank of England. There's question marks about whether we see them cut rates in December or not. That's the only possibility really at the moment. But yeah, inflation remains a problem in the UK. And so that's probably going to be a key theme Notably, one of the themes, talking about themes of the Jackson Hole Symposium, comes around the labor market and developments on that side of things. I think this is going to be really interesting because if you're taking weakness in the jobs market, as we've seen recently with those revisions for the payroll, suddenly making everyone think we're going to see a raft of rate cuts from the Fed. If you're taking the lead from the jobs market, you have to be aware of the fact that AI in itself is causing unemployment, right? We're likely to see higher unemployment when computers can essentially do our jobs better than us. And so does that mean that central banks are just constantly cutting interest rates because they think that the economy is under stress because we're seeing higher unemployment or low payrolls? Remains to be seen. I think it's going to be a new world order, and where the sort of equilibrium unemployment rate will be down the line, that remains to be seen. But these central bankers will have to get to grips with what the new world looks like and how the jobs market's going to be impacted by AI. And just because we see job losses doesn't mean that the economy is doing poorly. The economy, and in particular the businesses, might do incredibly well, but there could be higher unemployment because they're doing it very well off the back of laying people off and replacing them with robots, essentially. So an interesting meeting up ahead. Hope this has been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thank you.